provider of forecasts, research, data services, and consulting. We were formed in 1981 as a joint venture with Oxford University, and while we maintain close links to the university through our management board and empirical approach to research, we are completely independent. Our time economists, 190 different countries, 100 industry sectors, and over 3,000 cities and regions. And today I'm joined by a key member of our global macro team, Ben. He joins us as one of our senior Eurozone economists from Capital Economics, and obviously to that, the Bank of England. And given the interest generated from his recent research brief titled The ECB's TLTROs, Bazooka or Peashooter, he's here today to talk to us about why the market seems to be underestimating its potential impact on the Eurozone. Now, you'll see in the right-hand side of your screen, for those of you that are joining on WebEx, you have a bit to ask questions. Please feel free to do so, and turn to Adrian Katerian. And if you have more general questions, my contact details as financial markets here are on the screen. So please feel free to get in touch with me at any point during the presentation or after regarding research services. So without further ado, I'll pass the reins over to Ben.
Thank you, Aka. As I already said, I'm going to talk a bit about the possible effects of the policy measures ECB. To begin with, I'll just give a brief outline of what I'm going to cover in this presentation. So I'll begin with looking at what the impact of the measures that have been already had on financial markets and the economy. I'll then look at how the TLTRO program works. I'll then look at how much demand there may well be for the loans from the banks. Then I'll look at whether we think that there's a reasonable chance of a picking back lending on the back of this program, and finally look at what the likely effects will be on the economy. So, into the TLTROs themselves, I'm just going to briefly focus on the recent impact on financial markets of the measures announced by the ECB. So with this chart here shows overnight Eonia and 3-month Euribor. You can see soon there's been some reasonable falls in both measures, and in fact, while Eonia is fairly volatile, both and the 3-month Euribor are now pretty much close to or at record lows. So I think it's fair to say that the measures that the ECB announced have had some success. Importantly, long-term yields have also fallen, and the declines have been particularly apparent since the June meeting. The chart shows that the yellow line is the forward curve for treble rated sovereigns in the Eurozone. And as you can see, relative to the May and June meetings, this rate is now about 35 basis points lower, so a not insignificant amount. Now, maybe part of that's down to international factors. So the equivalent 10-year US yield has fallen by about 10 basis points. But this suggests that there's probably been some Eurozone-specific factors going on, which may be to a large part down to the ECB's actions. For instance, it may well be that markets are expecting the TLTRO program to be a success and it to provide banks with a significant amount of money that they may well pump into the sovereign bond market. Alternatively, it could even be a sign that markets now think that QE by the ECB is more likely. But despite these reasonable falls in interest rates, the fall in the euro has arguably been, until recently anyway, been a little more muted. Nonetheless, I think it's important to note that the upward trend in the exchange rate over the past year or so, which is apparent in the chart, has to an end, and certainly Fed, the euro would have reversed some of those initial falls that we saw in May. And I think the final point to note is that really the exchange rate is also driven by other factors, and the recent weakness of the GDP figure, the US figure, another reason why perhaps the full euro is a bit more muted than maybe the ECB might have hoped. Using a global economic model, we can assess what the financial market impacts of the economic effects of these financial market moves likely be. And while it's fair to say that these should have had a positive impact on the economy, they're fairly small beer in the grand scheme of things, and they don't really change the fundamental outlook. But anyway, the TLTRO program has potential to have a much more significant impact on the economy. To illustrate how significant, in theory at least, it could be, this chart just shows the size of the TLTROs to a number of variables. So overall bank lending to the private sector, Eurozone GDP, and Eurozone banks' assets. This is an assumption that there was 100% take-up of the TLTRO program, so we're talking about €1 trillion. So as you can see, that trillion is pretty significant in the grand scheme of things. And therefore, at least in theory, that suggests that there's certainly the potential for it to be something of a game changer. Is that the TLTRO program will affect banks throughout the region. This here just shows the estimated share of TLTROs for all the different companies based on the assumptions that they took up their entire allotment. So before going into a bit about how high we think the take-up will be and the knock-on impacts of that, I'm going to very briefly go through some of the details of the program. About $1 trillion can be borrowed by banks on this program. Up to $400 billion can be lent in the first two TLTROs, which take place in September and December. And around the $600 billion can be lent out by the ECB at 6 subsequent auctions, which take place over an 18-month period in 2015 and 2016. All the loans will mature in September 2018, so that means that the first TLTRO will have a maturity of about 4 years. Interest rate will be fixed at the refi rate at the time of the auction, plus a 10 basis point addition. So that means, under the assumption that the ECB don't increase interest rates for the foreseeable future, you've got a guaranteed interest rate of 0.25% to pay. On the first two auctions are based on the amount of outstanding lending to the private sector that they have as of April 2014. But then subsequent entitlements will depend upon how much they've lent relative to a benchmark beyond May. Finally, there are conditions that must be met to avoid having to repay these loans early. As I'll talk about later, we don't think that these are especially onerous. Of course, it's uncertain how much demand there will be for these loans. And on the face of it, you can perhaps make a reasonable case to suggest that it could turn out to be a bit of a damp squib. For many banks, the priority is still to reduce the size of their balance sheets. So even offering quite attractive loans might not really particularly to borrow more. And as the chart shows, what you can see is that the outstanding three LTROs that have been lent out to banks have been falling over the last couple of years as banks repay these 3 LTROs early. So it's not clear why banks on the will be rushing to take up this TLTRO scheme. But despite all that, we certainly think that there are some good reasons to think that the take-up could be pretty high. we think the basic premise of the scheme suggests that the ECB is to a certain degree admitting that perhaps the stress and AQR have gone a little bit too far and have perhaps discouraged banks too much from lending to firms. If the case, then essentially the ECB are perhaps tacitly being that's gone a bit too far and giving banks perhaps some encouragement to take up this scheme and use it to pass on and lend to businesses. So we could perhaps argue that there's not going to be a huge stigma to taking out these loans. More importantly, though, I think the interest rate looks enticingly low. Admittedly, banks may be able to borrow slightly more cheaper from the ECB by taking out 3-month LTROs and repeatedly rolling them over. If you believe that the ECB will end its fixed interest rate loans and might potentially increase interest rates over the course of the next 4 years, then it will be the case that these TLTROs are rather cheaper than that. And in addition to that, it's obviously more convenient borrowing for a 4-year period rather than repeatedly rolling it over. Having taken a closer look at the conditions of the programme, we don't think that they're particularly onerous. In other words, most probably won't have to dramatically change their lending behaviour in order to be able to avoid paying these loans back early. The final note is that even if perhaps banks misjudge the situation and find that they can't make money out of these loans, which we think is unlikely, they repay these loans early. So perhaps another reason why banks might be prepared to borrow quite heavily in the short term. We think the take-up is likely to be pretty high. It's important to bear in mind that whilst $1 trillion could be borrowed by banks over the coming year, there's going to be a setting impact on ECB lending to banks associated with the 400 billion or so repayment of 3 LTROs, which will take place in January and February. So essentially shows plausible profiles for ECB lending to banks based on a number of different assumptions. So the bottom line shows what would happen to bank lending to the ECB if over the years as the banks pay back those 3-year LTROs under which there was no take-up. And then the lines above show what would happen to lending under various assumptions of the different take-ups. I think what's clear from this is even if there was a take-up of about 50%, we'd still see lending being either a bit lower or broadly in line with the current amount of ECB lending to banks for the next couple of years. Even if there was 100% take-up, ECB lending to banks still wouldn't reach the peaks that we saw in 2012. So in other words, perhaps this new plan might be a bit smaller than the trillion headline figure suggests. The next to note is that there's no reason why supplying credit will automatically lead banks to lend more to firms. As I said, the lending conditions aren't particularly onerous, and it may well be that banks, even if banks do take up this money, they'll use it to fund other things, for instance, buying government bonds. To note is that even if lending does pick up, it might be down to the TLTROs. So this chart here, if you look at the red bar, this shows the change in lending to the private sector over recent months. And I think what's reasonably clear from this is that there's those red bars over the last 8 months have become steadily less negative. So if we would see a continuation of, might expect to see a continuation of this trend over the coming months, regardless of whether the TLTRO program comes into place under the assumption that the recovery continues. Another thing to bear in mind is that banks do increase their lending. It may be offset by firms borrowing less in other markets. So, for instance, loans might issue less bonds if they can borrow from the banks at very attractive interest rates. So, just even if lending does pick up, it doesn't necessarily mean that firms are getting greater access to funds. So, on that, I think it's perhaps difficult to argue that we're going to see a substantial boost in bank lending, in that we're unlikely to see the bulk of that money being passed directly onto firms. If that's the case, we still think there's potential for the TLTRO program to have a reasonable impact on the real economy. We've done some scenario analysis using our global economic model. We've looked at two assumptions. First of all, that the TLTRO program increases investment via bank lending by 50 billion euros over the duration of the program and 100 billion euros over the duration of the program. So to those numbers in a bit of context, if there was a 50 billion pickup in and banks borrowed approximately 750 billion from the ECB, so about 3/4 of the maximum amount. That's essentially a 7% pass-through. It will be closer to about 13%. So if we see first a 50 billion pickup investment over the next couple of years, I should suggest that would boost GDP, the level of GDP, by about 1.3% by the end of 2018. It would increase in employment by about 0.6% relative to our baseline over the same period. And it would increase inflation by 0.4 percentage points at the end of 2016. If we scenario of 100 billion, the figures are roughly double, so it would lead to a boost in the level of GDP by end 2016 of 2.6%. It would boost employment the same period by 1.2%, and inflation in 2016 by 0.8% relative to the baseline. So, clearly these are reasonably significant numbers. So bear in mind, even those kinds of shocks to GDP will still leave the Eurozone, by calculations at least, with quite a large output gap. Of course, uncertainties around these. Could just be far too big. It may well be that investment, even if we were to see investment increasing by roughly this amount, it might take over a much longer time period than we've assumed is the case. Obviously, the impacts in the shorter term would be rather smaller. So it's based on the assumption that there's actually demand for lending out there, that it's really supply the supply of lending that's constraining investment. Of course, if firms don't want to borrow money, then obviously the impact of the TLTROs could be rather smaller. So, going on to what we think the implications of all this are for monetary policy. The first point to note is that the impact of TLTROs is highly uncertain. It's going to take some months before we've even got an idea of whether it's likely to have a big or small effect. The first auction isn't until September, the second isn't December. A while before we are able to discern whether there's been any change in banks' lending behaviour beyond that. So I think it's probably December at the very earliest before you could even make quite partial judgments about whether the program's having an effect. And really, it's probably several months after that before you can say anything with any certainty. Nonetheless, as I hope we've sort of indicated, that there's potential for it to have reasonably large effects on the macroeconomy if it does prompt a pickup in bank lending to firms. We think it will probably that the ECB will want to see some strong evidence that the program has failed before it's prepared to contemplate further significant policy action. It will be that essentially the ECB is going to, or at least the governing council members are going to sit on their hands for a month, perhaps even a year, before they're willing to think about undertaking other major policy action in the absence of any further major shocks. So we suspect that the worst of the negative effects of inflation from energy and food prices will have subsided, and it's possible that the euro may have weakened a reasonable amount by then. And in the case, we suspect inflation will have started to rise. While it will still be some way from time, I think it will be the case that perhaps the perceived risk of deflation will be lower than perhaps many think it's now. And in that case, it will be that the ECB feels that there's no need to contemplate taking QE in that environment. So, based on that, I think we feel that really supports our idea that QE won't take place. That really that now from the ECB. So with that, I'm going to finish there in terms of the presentation. But clearly, if anyone's got any questions, I'm happy to field them now. Alternatively, if you want to contact me, my email is here.
Well, looks like we do have a couple questions. Obviously, there is time for more questions, so do feel free to enter them into the box, but we do have two to start with here. What on the time frame? How soon will it be before we are able to judge whether the TLTRO scheme has been a success?
First of all, the first auctions don't take place till September and December, when up to 400 billion can be borrowed. So one knows we'll have a clear idea of exactly what the money take-up is going to be over the course of the program. So I think the September is the earliest you could even make partial judgments. If you want to start seeing whether there's been an impact on either the amount of lending or the type of lending that banks are providing to firms, then they're probably going to have to wait several more months. Probably like February or March before you can even start to make some reasonable judgments on that. So I think you're talking at least 6, 9, possibly even 12 months before you can really say whether this has been a game changer or not.
Okay, second question. Which economies are likely to benefit the most from the program?
I think probably a lot of that depends on the state of the banks in those economies. So I think, as I showed the chart, it shows in theory at least banks from all over the region will be able to use this facility. I would say that it may well benefit the peripheral economies more because there perhaps banks are under more pressure and may be struggling to access credit more than perhaps in the core countries. So if that's the case, perhaps you might expect the periphery to benefit a little bit more from it than the core. And the periphery have taken much more advantage of the 3-year TLTRO program would support that. So I think probably you'd be expecting the periphery to be the biggest recipients of that. But perhaps time will tell.
Looks like we have one more question came in actually during that time period. The euro-related question. Assume that there is a strong take-up, what will the impact of the TLTRO scheme be in the euro?
Well, that depends a lot on how that money is used. It turns out that the taken up by the banks, for whatever reason, they're not really passed on to, but they're essentially used to buy financial assets. You could almost say that this is a QE type program. In this scenario, I suppose, if they're starting to push down on asset values, maybe it might even be expected to cause the euro to weaken. However, if it's really quite successful at setting the recovery and strengthening it, because it does lead to a reasonable pass-through to bank lending, then arguably it might call into question whether the ECB is likely to implement QE further down the road. I think certainly some investment banks are now suggesting that QE is much less likely, and are perhaps taking the view that the programme is not, rather than the build to QE. If it was to boost growth and close the output gap more quickly than people are currently assuming, that might also imply that the interest rates will rise a bit quicker than perhaps some people might even be thinking. In that case, I suppose you could argue it might even eventually boost the euro. But the balance in the shorter term, I suspect that it's more likely to lead the euro to weaken further rather than to strengthen it.
Okay, thank you. That's all time for now, but I thank you all for attending today's webinar. Of course, if you do have any further questions, then you do have Ben's direct contact details. We do appreciate and encourage our clients to get in touch with our economists directly, so please feel free to do so. Alternatively, if you have any questions regarding the service, please find my contact details on the first page, but feel free to get in touch with me directly too. Thanks for your time. Have a good weekend.